everyone, and welcome back to Talking Taxes Part 2. We are so grateful to have Tiffany and Liberty, both of KHBB Law, back with us again to answer some more questions that you all had after the first webinar we did on February 21st. So I'm going to let the two of them take it away, and thank you all for being here.
Thanks, Kara. Well, thanks again to everyone who attended on the 21st and those of you who've had the opportunity to watch the recording on YouTube since then. What we did that day is we talked a lot about taxes, and the tax code is very voluminous. And even though we were only talking about things related to estate and gift tax primarily, there are still so many things that we can cover. And we had an hour to do that. We got to some of the questions after the fact, but what Liberty and I wanted to do after that is we had an opportunity to go back through some of the questions that we didn't get to during our session on the 21st. And so we looked through those and kind of found some common themes and common threads. And so with our time today, what we're really doing is we took your feedback. So thank you. And in the future, it's very important for you all to participate in the surveys because we do listen and we really do care and want to make sure that we are able to fulfill and kind of fill in the gaps, so to speak, where you have additional questions. So this session was really born from your questions. And so we're assuming today that you either attended on February 21st via Zoom, or you've since watched the recording. And so we're not going to go back to the basic detail that we started with back on the 21st. What we're really doing is kind of building on the assumption that you've already spent about an hour or an hour and a half with us on those topics. So just to kind of make it really clear, we are talking about estate taxes and people who are taxable in Washington and to some degree at the federal level with respect to estate tax only. So this does not have anything to do with the fact that all of us who earn any income each year have to pay income taxes. This is a different tax. And what this means is that in Washington, your assets overall total $2,193,000 or more, because that puts you in a position of potentially having some planning to do surrounding the estate tax here in Washington. And that is, those individuals are who are going to get the most out of this session and out of our February 21st session, because it really does focus on that type of a tax. I mentioned on the 21st, and it's worth reiterating that at the federal level, it is over 12 million per person in terms of an exemption amount. Each individual has their own exemption. We're kind of going to focus on some of the detail related to Washington today, but it's worth raising the issue of that federal exemption amount for estate tax purposes as well, because that is out there, although it's significantly higher and it doesn't affect as many people as the Washington estate tax does. It's worth noting. And so, as I say, each individual has this exemption amount that they're able to use at death in order to either alleviate or reduce exposure to potential estate tax. So whether you're single or married, this is a tax that affects all individuals when the threshold of $2,193,000 in assets is met. And so if you're married or single or otherwise here today, you could be subject to the estate tax. So there's planning for everyone to be had. Of course, as with many taxes, if you are married, oftentimes there are some benefits and opportunities to sort of double up or utilize the other spouse's exemption amount in the case of estate taxes. So that's true with respect to this tax as well. But this is also a tax that affects single people. So important to note that. So each individual has their own exemption. And what you are thinking about as we're kind of calculating that amount, when I say in Washington, you may be taxable or your estate may be taxable if you have over $2,193,000 in assets. We're looking at all assets. So we're looking at any real estate, your house, a vacation house, all real estate, your retirement account, your bank accounts, your checking account, your savings account, and importantly, life insurance policies. Life insurance is one thing that oftentimes folks don't think about as an asset because I don't spend my own life insurance policy proceeds. And so I don't, in my own mind, think about that as an asset. However, oftentimes when I raise that issue with clients, they'll say, oh yeah, I do have a $500,000 policy or $1 million policy that I forgot to tell you about. Well, that is a hefty amount when you're looking at overall assets up to the level of and beyond that $2,193,000 figure. And so again, that the estate of an individual includes all their assets, including potential life insurance proceeds, even though those are going to be paid to some other beneficiary. If you're married, we're talking about both your separate property, so assets titled in your own name, and not included or your spouse is not included necessarily on title, but we're also talking about your community assets. We live in a community property state. There are a lot of folks, when you're married, there are a lot of assets that are going to be presumed to be community. And so essentially we're looking at when someone dies, their separate property that they own as an individual without anyone else. And similarly, their half of any interest that they have in the community assets as well. And so when we're talking today about the estate tax and some of these planning tools, we're looking at a very big umbrella, under a very big umbrella of all assets, including things that are titled in our own names and those that some of those of us who are married are titled with our spouse as well. Again, we're not talking about income tax planning today. We're talking about estate tax planning, but one of the quote unquote kind of income tax pieces that can come up is related to things like basis in an asset. And so you will hear some discussion about that today as well. A lot of folks had questions about how giving to charity, if that can reduce the amount of estate tax or otherwise, eliminate you from this world of having to think about the estate tax. And the answer is it gets rid of or can potentially reduce the value of an estate and can reduce someone's estate value such that there's not going to be any estate tax owed. But if the overall assets in total before we remove any contributions to charity are of more than $2,193,000, there's still a reporting requirement, meaning if I die and I had $3 million in assets and I gave it all to charity, I would have no estate tax due. But because my estate, being 3 million in this made up example, is more than the $2,193,000 Washington state exemption amount, then my estate would have to file an estate tax return, even though they would be reporting $0 due as the tax amount. So we're going to talk a little bit more about some gift tax and gifting strategies in kind of the second half of this discussion. And we'll talk a little bit more about giving to charity there, but just to kind of emphasize the fact that it's important, it's a good thing to do, and it does indeed reduce and can eliminate estate tax owed, but it doesn't negate or get rid of the requirement to file that type of a return. And so kind of moving to some additional tax topics, Liberty, I'm going to turn this over to you to talk some more about the Washington and federal exemptions.
Yes. So as we mentioned in our initial presentation and what Tiffany just mentioned, with the Washington exemption amount, we're really dealing with estates over the $2.193 million. And then federally, we're at $12.92 million right now per person. So individuals, each person, and then in a married couple, each person in that couple has this exemption. So the Washington exemption is just upon death. That's all we're concerned about. There is a snapshot, date of death. Do you have more than that amount? If you do, then what we're talking about here will impact you. Federally, it's a gift and estate tax exemption. Like Tiffany mentioned, we're going to go over gift taxes towards the end of this presentation, but it's important to note that the federal exemption of $12.92 million is a use it during life gift exemption, or if you don't use it during life and it's still there upon death, then it'll apply upon your death. And that federal exemption is currently indexed for inflation, but it's temporarily high at the moment. So the 12.92 is temporarily high, and that drops back down at the end of 2025 to $5 million indexed for inflation. based on the way inflation has gone the last couple of years, most projections show that that will be around $7 million per person, somewhere between 6 and 7, most likely. And so when we're talking about estate tax planning for taxable estates, we're really like 2025 isn't that far away at this point. So when we're talking to couples, we're definitely mentioning that that both of those taxes may apply. And same thing with single individuals. We're looking at both state and federal estate taxes and kind of looking out, assuming death will be sometime further in the future, that we're more likely looking at probably around $7 million for that exemption amount. So there was a lot of questions kind of in the chat of like what assets are included in this and how are they valued. So Tiffany just kind of went over, we are literally looking at everything that is owned as of the date of death, and that includes insurance and things along those lines. So it is a date of death snapshot where we start gathering values. You've got a personal representative either administering your estate, or you've got a trustee administering your trust. And in either one of those scenarios, they were basically sent out into the world to start gathering asset values. So we're talking to banks, wherever you have stocks, brokerage accounts, things along those lines, we're getting date of death snapshots of those assets and reporting those values. For things like real estate, we're usually doing things like actually getting appraisals for those things. For items that are tangible personal property around your home, most of those things, unless you've got collections or assets that are going to be more than $3,000 in value. So art, silver, pianos, things along those lines, things where they're actually more than $3,000 in value, those are going to require appraisals. Things like your clothes and your furniture and a lot of those type of things are just going to be truly an estimate of the value. And it's like garage sale value, not replacement value of these things. They have a lot of meaning and value to you, but when we're reporting them to the IRS, we just want to know kind of what could this just be sold for at this point. So things like real estate and stock, like those are things where we're going to get actual values for those. There are other things like smaller items where we're estimating. But for the most part, we have to be able to back up that information. So we're giving this information to the Washington Department of Revenue or the Internal Revenue Service. So we're listing all of these assets and saying, here's the appraisal for the house. Here's the brokerage statement for my account, all those things. So they're looking at those things and seeing how we actually valued them. So it's really important to know those values because the people who inherit those assets get that basis as of the date of death. So when assets are received from someone who dies, we value them at that date of death, and whoever receives those assets gets that basis. So it's really important for things like appraisals to be able to show what the basis is in those assets. So that's how we're valuing them and why we care what the value is. So one is reporting the value accurately to, state what the tax would be due, and the other is for the people receiving it so that they know what their value is in the asset. We had several people ask questions about kind of how the taxes are calculated and what happens if you're taxable in Washington and federally. So basically, we take that date of death snapshot and we determine what is the tax. If Washington taxes are being paid and we have a federally taxable estate, the federal tax return is going to take into account those Washington taxes paid. So we're going to look at the entire estate. We might be paying taxes in both, but the IRS at least looks and say, we see that you paid Washington, we're not going to ding you for also paying Washington taxes. So they're taking into account that tax paid. We had a lot of people asking questions about kind of avoiding probate. And there was some confusion there on avoiding probate versus minimizing taxes and paying estate taxes. So there were multiple questions in different ways about transfer on death deeds or payable on death account designations for bank accounts, or holding assets as joint tenants with right of survivorship. And those are all methods to avoid probate, which probate is something that Tiffany has explained in a prior presentation on wills and trusts, but just kind of the down and dirty version of it is it's filing your will with the court. So once the will is filed with the court, an executor is appointed, and then they get the power to go out in the world and transact upon the deceased person's behalf. They're getting values, they're selling assets, they're distributing assets. And so sometimes people want to avoid this. If you've done any of your own research on estate planning, a lot of that information is geared towards states like California that have a terrible probate process. Washington's probate process is not terrible. So it's not necessarily something to be avoided. It is a public document. The will is filed with the court. Somebody could potentially see it, but generally, if you're working with a good estate planning attorney, they're going to make sure that people can serve without really court intervention. In California, that's not the case. Same thing with Oregon. There's a lot of states where courts are kind of involved throughout the process, and you have to go back in and check in with them. Generally speaking, in Washington, that's not going to be the case. So avoiding probate in Washington is something you can do, but it's not quite the necessity that it really is in states like California, where you'd be silly not to have a trust. So in Washington, you really do have the option of will versus trust. And when we're talking about avoiding probate, we are talking about doing things like power or payable on death, joint tenants with right of survivorship, revocable living trust. These things all may avoid probate, which is that filing the will with the court, but they don't really take away any of the burden of administering an estate, and it still is counted in your estate for estate tax purposes. So it doesn't remove it from your estate just because it's transferred on death automatically. Doesn't mean that we don't care that you owned it on your date of death, and we're including it in that date of death snapshot value of what did you own? This is what you're taxed on. So there still may be tax due because you owned that property. So those type of probate avoidance vehicles aren't really going to help us in that sense of minimizing estate taxes. The next question that we had a lot of people ask was about the marital deduction. So this is one thing that only applies to married couples. It does not apply to single individuals. So this is a situation where both in Washington and federally, if you leave assets to your spouse, you have an unlimited marital deduction where there's not going to be any tax due. So if your entire estate goes to your spouse, great. There's a deduction for that. There's no taxes due. An estate tax return still may need to be filed if your estate exceeds that $2 million, $2.193 million exemption in Washington, or the $12.92 million federally. You might have to file, but taxes may not be due at that point. So we're saying, hey, the estate was over this amount, but it's going to a spouse, so we're using the unlimited marital deduction. So I'm going to share my screen here and just kind of visually show what we're talking about here. So when we look at a married couple's estate, we generally look at it and say, okay, we're splitting the estate in half and saying half of the estate belongs to the deceased spouse, half the estate belongs to the surviving spouse. And that's because we're in a community property state. So it might be individually different depending on the scenario, but just kind of in general, that's the way we refer to it. So if everything goes outright to the survivor here, then everything ends up in the blue box here to the surviving spouse. Unlimited marital deduction, no taxes due at that point. But what happens here is if the estate is going to exceed 2.193 million, we will have a scenario where there will be estate taxes upon that second death. So one of the ways that we kind of take advantage of both people's exemption, their individual exemption, is that we I want to go to the next slide. What we do instead of doing this outright to the person is we set up one or more testamentary trusts. So I'm going to go into what a testamentary trust is, and this applies to individuals and married couples. When we're setting up a testamentary trust, what we mean is we're setting up a trust for another person upon death. So this would be in your will or your revocable living trust. And what we're doing here is we're saying, upon my death, I am going to put assets in trust for another person. So when you create a trust for another person, there are multiple benefits for that. So whether this is a trust for a spouse or a trust for a kid or your nieces and nephews, doesn't matter. There are benefits to doing trusts for people when you set it up for someone else. So one of the first things we look at is utilizing your estate tax exemption. By allocating your exemption to a trust, then the person who receives that assets it will not be subject to tax upon their death. We're taking care of the exemption, allocating it to a trust. It keeps the assets in that trust protected from taxes kind of moving forward. So this is estate taxes only. We're not talking income taxes. That's a whole different topic. But with estate taxes, if you allocate your exemption to it, other people benefit from that. Another reason why we set up trusts for other people is creditor protection. So when a testamentary trust is created for somebody else, the assets in that trust are not actually theirs. They may get the benefit from it. They may be the trustee of it and in control of making investment decisions and distribution decisions, but the assets are not actually theirs. And so when something happens like terrible and they get into a car accident and get sued, or they get a divorce, those assets are not actually their assets. And so putting them in a trust protects it from their creditors. Another reason that we put assets into a trust is when we don't trust the person that we're giving them to. So we can let them be the beneficiary and the trustee. And there's other times where it might make sense to have somebody else be the trustee and managing those assets for someone. So it doesn't mean we don't want them to receive something. They just might not be the best person to be managing those assets. And one of the last reasons we use trusts is really a manner of control. And so this applies a lot to blended families, because when you create a trust for someone, one, you dictate the terms, but two, you also dictate the terms of what happens when they die. So you're controlling it not only during their life, but upon their death. And so with blended families, a lot of times we want to set up a trust for the surviving spouse, but upon their death, we want it to go back to the first person to die's children. So kind of looking at this in the diagram here, if we set up a trust where we have the residuary trust here for the surviving spouse, we're utilizing estate tax exemptions in the most efficient way. So if the estate is only $4 million for the couple, and we've got $2 million on the yellow side and $2 million on the blue side, we're funding one trust for the surviving spouse with that full $2 million. If it exceeds that amount, if the estate is going to be $10 million, and we've got $5 million on the yellow side and $5 million on the blue side, we're funding this first trust with that first $2 million that's Washington exempt, federally exempt. The second trust, we are funding over that $2 million, so the next $3 million. So this trust will be set up for the surviving spouse, and upon the surviving spouse's death, whatever assets in this yellow side will be controlled by the first person to die's will. So if this was a blended family, first spouse and second spouse had different kids, we could make sure that the half that was here in yellow goes to different beneficiaries than what the surviving spouse may want. So when it comes to testamentary trusts, this could be set up for spouse. Again, this could be set up for kids. These are all, we want to use trusts for estate tax planning for people, whether it's married or single. We want to do these things for people. People ask what happens when the beneficiary dies. This is really up to the person creating the estate plan. It is really just, it can be kind of whatever you want it to be. So when you're setting up a trust for someone, you get to say it goes in trust for their lifetime. Upon their death, it goes to charity. It goes to my kids. It can really be whatever you want it to be. We had people ask about disclaimer trust. So a disclaimer trust is a trust that we're kind of punting the issue, basically, of we're creating a estate plan where for a married couple, we're going to build in the foundation of there could be a testamentary trust for the surviving spouse, or there could not be. So the will is basically going to say, I give everything outright to my spouse, but if they disclaim, which a disclaimer is basically saying, no, thank you, I don't want the property. If they disclaim, then that disclaimer will automatically funnel it to a trust for their benefit. So a lot of the times this will be used for people who are kind of on the edge of being taxable or not. And if they're not taxable, they don't want to go through the hassle of setting up a trust. But if they are going to be taxable, then we do want to do that planning to take advantage of both exemptions from each spouse. Because if it goes outright to the spouse, we're not taking advantage of that first person to die's exemption. So this is a tactic that some people use for estate tax planning when we just don't know if it's going to be necessary or not. So yes, it can save on taxes, but it's just like the rest of the trusts we were talking about, which we mentioned in the first presentation, that this can go by many names. It can be a credit shelter trust. It can be a marital trust. It can be a bypass trust. They're all doing the same type of thing. We're providing creditor protection. We're allocating exemptions to it. All of those type of trusts are going to be the same. The disclaimer language is just that it's not automatic, that there's some election that the decedent, that the surviving spouse has to make. And it's really important to note that that election has to be made 9 months within the date of death. So it is sometimes a frustrating process for the survivor to try and figure that out. One, they've lost their person and they're grieving. And two, they're trying to gather asset information, all of those things. So it's some pressure on the surviving spouse to kind of be projecting and making assumptions about what's going to happen in the future as to whether or not they want to make that election. But it is something that's available. We had several people ask questions about the costs involved for these trusts. And so the way that these trusts are going to work is, one, there's building your estate plan. So actually drafting a will or a trust to include these documents. Different attorneys bill differently for this. Some bill hourly, some have a flat fee. It's really just going to depend on the estate planning attorney that you're working with. But what's going to happen is upon death, your estate will go through probate or a trust administration, and that's going to be an hourly process to actually value the assets and then fund these trusts. Once the trusts are funded, it's really going to depend on who's managing the trust. If it's your surviving spouse or if it's your child for their own trust, those expenses are going to be pretty minimal because they're the person who's managing the assets. There, will be income tax returns, things along those lines that they may need to do. They can work with a CPA, they can work with financial advisors, all of those things. So if it's the person who's the beneficiary who's also managing the trust, the expenses are pretty minimal. If that person is not appropriate to manage their own trust, then we look at professional fiduciaries to manage a trust. So that can be something like an attorney or a CPA who kind of has two different practices, one where they actually draft estate plans and others where they serve in a fiduciary role like trustee. Others would be smaller fiduciary trust companies. There are a lot of those in Washington. There's some great ones in Seattle. And then from there, we go kind of bigger to larger banks and trust companies. And so it's really just going to depend on who you're picking and what their fees are. So their fee schedules, if you contact them, they will tell you what their fee schedules are. They will be adjusted annually, things along those lines. So when you have professionals in that role, the fees are more expensive, but also that's their job. That's what they do. This is what they manage trust. And so you're also getting that professional experience from people. So it's really just going to depend on what you want and what you're looking for. Going back to the marital deduction, we had somebody ask that if you give a portion of your estate to your spouse, how does the marital deduction work? And the answer there is, if you're giving a portion of your estate to your spouse, you get the marital deduction for that portion that goes to your spouse. And then we look at the rest and determine, is that taxable or is it not taxable? So sometimes people will utilize gifts to other people just under that exemption and have the balance go to their spouse. So we see that with blended families a lot of times, that first 2 million goes to my kids and then everything over goes to my spouse. So you can play around with the marital deduction and how you want that to work. So that kind of covers the bulk of the questions that we got from people in the Q&A. So now I'm going to turn it back over to Tiffany to talk about some of the gifting stuff that we just didn't get to finish up during the presentation.
Okay, thanks, Liberty. So yes, we, if you tuned in on the 21st or have since listened to the recording, you know that we had about 7 or 8 minutes at the end. And that is when I went through all the things that I could fit into 7 or 8 minutes regarding the federal gift tax. And so we had some, of course, follow-up questions, and just wanted to kind of come back online and spend a little bit more time talking more in detail about some of the things that we were able to just touch on the 21st. And there were a lot of questions about the kind of differences in tax planning for single individuals versus married couples. What we're talking about here with respect to gift taxes, we're kind of transitioning from the estate tax discussion to the gift tax discussion. And the things that we're talking about under this kind of subheading, so to speak, are related to individuals or married couples, regardless of kind of that status, who are in a position of having a potentially taxable estate, either in Washington, meaning that their assets are, over $2,193,000, or at the federal level, meaning that they're over that almost $13 million figure. And that's how the gift and estate tax kind of relate to each other. Is oftentimes when we're assessing circumstances and moving assets around, we're looking at a person's overall potential estate and then saying, are there gifts that you could make during your lifetime in order to reduce the overall estate that exists at death? And what are the potential gift tax implications of moving those chess pieces around the board, so to speak? So a gift tax is just like it sounds. It's a tax on a gift that's made, and it's a gift that's made during an individual's lifetime. So if I make a gift of $50,000 to my neighbor, that is a reportable gift, could potentially be subject to gift tax, depending on some other circumstances that we're going to talk about here in just a minute. That's different than if I include my neighbor for that same $50,000 under the terms of my will. That deals with gifts or transfers that happen post-death. And that is kind of the more of the estate tax world, whereas a gift tax comes into play when a living individual makes an actual gift during their lifetime. So the gift tax is payable by the person making the gift. It's not something that the recipient pays. Sometimes folks will wonder if there is an income tax on a gift that is received. So same example, I give $50,000 to my neighbor as a gift. I would be the person who has to report that. If there's any gift tax due, I would be the person who has to pay that tax. My neighbor doesn't have to report anything. They have no income tax associated with receiving that. It's a different type of tax, and it doesn't affect the recipient. There's no gift tax in Washington. So at the federal level, we already talked about the fact that the federal estate tax exemption is significantly higher than Washington. That is that almost $13 million figure. And in the gift tax is kind of linked to that, so to speak. So during each of our lifetimes, single or married individuals, during my lifetime, during your lifetime, right now we have this exemption amount of almost 13 million at the federal level. That's our gift tax exemption amount. As I make gifts during my lifetime to other individuals, not to charities, we'll talk about that in a minute, but gifts to other individuals or trusts to individuals where I'm actually parting with the asset during my lifetime, the gift is completed, the amount of each of those gifts will chip away at that $13 million federal exemption amount. Then whatever I'm left with at death, so say for example, I make gifts of 3 million or close to $3 million during my lifetime. I say 13 million less 3 million, that's 10 million left. So when I die, my estate tax exemption amount is reduced to 10 million. So it takes into consideration gifts made during life, and then what you have left at death, that becomes your estate tax exemption amount because they're linked at the federal level. Again, in Washington, there's no gift tax. So you can make gifts all day long as a Washingtonian. The Department of Revenue does not require you to report that. And there's no tax in the state related to lifetime gifts. Anything that is kind of subject to the federal gift taxes, again, just that transfers made during life from one person to another. So if I gift cash to my neighbor, if I gift real estate to my neighbor, if I give stocks or an interest in my LLC or anything that you can value, and I'm giving a portion of that or an entire amount to my neighbor, that amount that they're receiving is going to be subject to potentially to gift reporting. One big question here is, what about this $17,000 annual exclusion amount? Well, that is just that. It's an annual exclusion amount. Each individual person, regardless of married or single, has the ability to gift $17,000 to every other person that they wish. So I could gift $17,000 to 100 different people every single year. And there's no gift tax reporting at the federal level, no gift tax in Washington, so it's no problem there. And that doesn't chip away at my big gift tax exemption amount, because any gift at 17,000 or less for the year for one individual is not reportable and is not taxable. So sometimes folks will, you've probably heard of this before, sometimes family members, a parent will, gift their kids this amount at the end of the year. That's not uncommon for folks to say, okay, I'm writing my gift checks for the year. And it used to be 13,000, then it went up to 14 and 15. So, this amount has been adjusted for inflation over the years, and it's 17,000 now. So that is a handy way to make gifts to individuals during your lifetime without reporting on a gift tax return and without disturbing your federal estate tax and gift tax exemption amount. The annual exclusion for married couples, like I said, when we're talking about some of these tax issues, oftentimes if there's two people, it's doubled. So for a married couple, it's, spouse number one has 17,000 and spouse number two has 17,000. So my husband, Nick, and I are married. We could gift $34,000 to each individual, my $17,000 annual exclusion and his $17,000 annual exclusion to all four of my nephews if we wanted to, or to whomever. And that, again, is a handy way to reduce our overall estate for eventual estate tax purposes without triggering any tax. And one of the other benefits are folks get to see the recipient of the gift enjoy that during their lifetime. And so that's something that can be important to people who are kind of making these gift decisions. The question came up and comes up frequently of, okay, well, are there any deductions with respect to gift tax? There are a couple of specific types of gifts that can be made that can be above the $17,000 annual exclusion amount, but still don't chip away at the overall lifetime gift exemption at the Fed level. And those are primarily educational and medical. So say, for example, I have a niece or a nephew that I really love, and they're going off to college, and they would, I'd like to benefit them by, paying for some of their tuition expense. As long as I write the check, even if it's $20,000 a year, $50,000 a year, more than 17, so more than the exclusion amount, if I write my check directly to educational institution, that's not a reportable or taxable gift. It's a gift that I make similar to my $17,000 exclusionary gifts each year. But just because I've actually made the payment to the educational institution. Now it's different if I wrote that check to my nephew and said, here, go pay your tuition. Then it doesn't count. Then it's above 17,000. So I have to report it. But if I make the check out directly or make the transfer directly to the educational institution, there's no reporting, no gift tax ramifications there. Similarly, say that same nephew broke his leg and needed surgery on his broken leg, and I paid the $30,000 cost associated with that in medical bills. As long as I pay that directly to the healthcare provider, not to my nephew first, and then he goes and pays the healthcare provider, but I make the payment directly to the healthcare provider, then there's not going to be any gift tax assessed on that, and there's not any reporting requirement. So those are the two biggies in terms of kind of quote unquote deductions associated with the federal gift tax. A lot
Tiffany,
of
can I jump in here really quick on
Certainly.
the annual exclusion amount? So sometimes we have clients that are like, I do want to use this annual exclusion amount, but I'm not ready to actually give my kid or my grandkid that $17,000 check each year. And so we can utilize trusts set up during lifetime for kids or grandkids or things along those lines. And we can actually make those gifts to trusts where, maybe there's a professional fiduciary in charge, things along those lines where that's being managed. So we're still taking those annual chunks and putting them into a trust for kids, and we can still get that benefit using trust. So if it can go outright to them, great, and they can use it. And if we don't want it to go outright to them, there are still options for using annual exclusion gifting to create trusts for our kids and grandkids and things like that.
Thank you. Yes, great point. And you can imagine we see that a lot, particularly with minor beneficiaries. So grandma and grandpa want to make these gifts to, their children and their grandchildren, but grandchildren are, 5, 12, and, 8 or 17, or maybe they're 25 and they simply just don't want to have that gift go outright. But particularly for minors, that comes up. But as Liberty is saying, we can set up trusts that have those beneficiaries included as beneficiaries of those trusts and can make the $17,000 annual exclusion gifts right into that trust so that they're not required to give a check to a 5-year-old for 17 grand or similar circumstances, regardless of age. In terms of the kind of a type of plan that you may hear of that comes up very frequently in Washington because we don't have a gift tax, folks will say, well, what about deathbed gifting? What's a deathbed gift? Is it valid? Absolutely it is. If you have I don't know what to call it, the luxury maybe of knowing when, that death is imminent, or you have a long-term illness or something like that, and you're able to kind of do some of that end of life gift planning, it counts. It's valid as long as you have the capacity to do it. So for example, say you had a $5 million estate and you said, you know what, I'm terminally ill. I want to, make significant gifts now that I'm at the end of my life to my children or grandchildren or whomever. You can do that, make those lifetime gifts near the end of your life, and you could gift down to 0 if you wanted to. But you could certainly gift in that $5 million exemption, make a gift of approximately 3 million, and that brings you below the reporting requirement or potential tax requirement for Washington state, below that $2,193,000 exemption amount. We see that all the time because, as you can imagine, a lot of individuals, regardless of the shape or size of their estate, you want to make sure, you want to feel secure and make sure that you do have enough assets to carry out your days and live the life that you have planned and that you're accustomed to. And so sometimes folks will say, you know what, I'm not really ready to make irrevocable transfers yet. And then, they revisit that issue along the way and over the years. And then at some point it may become obvious that, that the end of their life is coming closer. And then they're more comfortable parting with those assets because they have that security is already met. And so that's something that we see very frequently. In terms of whether kind of what assets to make gifts of, this comes up very frequently with respect to retirement accounts. So individual retirement accounts, if you're over, I think it's 70 and a half, I always have to look up the number every year because they do shift, and you're taking required minimum distributions, RMDs. One way to get the most bang for your buck out of that, particularly if you're already charitably inclined, is say there's a $50,000 RMD that you're required to take each year, and you say, I don't actually need that income. And when I receive that distribution, I'm going to have to pay the income tax on whatever income is built in to that particular payment of $50,000. Instead, you could say, I'm going to direct this RMD to go to the Seattle Public Library Foundation or the King County Public Library Systems, or, insert charity that you love of your choice. And by having that RMD go directly to the charitable organization, one, you're not paying the income tax on it because you didn't receive it. You've been able to benefit the charity that you already care about anyway. And the piece that is really, I think, interesting and really cool is that the charity is not required to pay income tax on that. So a dollar is not necessarily, all dollars are not created equal. But when you have an RMD and you give it to a charity, or you direct it to be distributed to a charity, rather, they're getting the full benefit of all 50,000 of those dollars in that example. Whereas if I take the RMD, the required minimum distribution, I have to pay the income tax on, the income portion of that. Similarly, when you're doing kind of some on the estate planning side, if you're, making, your overall global estate plan, and you say, you know what, I have this retirement account, I'm charitably inclined, I would like to it behooves you, it makes sense, and gives you the most bang for your buck to leave that retirement account to the charity, because again, they're going to take that income tax free versus a retirement account that goes to an individual. They have a 10-year window within which they have to take all the distributions from that entire account, and there are income tax ramifications. So each distribution that individual takes has some income built in to that distribution, and they're taxed at their own individual income tax rate. So say, for example, you have, a brokerage account and a retirement account, and you have one individual who's paying tax at 37% because they're in the earning, phases of their career, so to speak, and you're also wanting to benefit charity. Well, when given those types of options, it makes the most sense to have the brokerage account go to the individual and the retirement account go to the charity. Of course, you want to look at all the math and make sure that the amounts are appropriate and you're happy with them. But when you're just thinking about, in general, kind of assets and how they're created in terms of gifts, are all gifts created equal? They're not. And so that's something that's important to consider. Going back to one thing that both Liberty and I have touched on today is related to that charitable tax deduction. And some folks will want to know, they're charitably inclined anyway, but a lot of times folks will be thinking about their estate tax planning and charity as a component of that, because like we said, assets that go to a charity from your estate are going to reduce your actual taxable estate, and may reduce or eliminate potential exposure to estate tax. You may still have to file an estate tax return for reporting purposes, but it might be a situation where the assets are reduced based on the gift to charity to below the actual taxing threshold. And sometimes folks have specific charities in mind that they've either been long-term supporters of, or that they've, loved for however long, and they want to include them in their will or under the terms of their trust. And that's fantastic. They can do that. But a lot of times, and I'm seeing this more and more, where folks do want to benefit a number of charities, or they're still kind of thinking about, they have some kind of foundational causes that are important to them or near and dear to their heart, but not necessarily certain of the way that they want to allocate percentages or dollar figures to ABC charity. And one thing that I recommend a lot of times in my planning conversations with clients is that they investigate the donor advised fund, a DAF. That is something that, Fidelity, Charles Schwab, any brokerage house will have a version of this. But basically, it's sort of like a little account. It's a charitable account, so to speak. And you can contribute to it during their lifetime and take charitable deductions on your income tax return for doing so. Or you can include it or you can include it under the terms of your will or your trust or your retirement account beneficiary designation or bank account beneficiary designation for gifts at death, transfers at death. And it allows you to tweak over time the organizations that are included there, maybe the percentages that are going to each. It gives you some flexibility where you can include language under the terms of your will that provides that, I want X amount or the residue of my estate to go to my donor advised fund, to the Tiffany R. Gorton Donor Advised Fund. And then if you do want to make some tweaks along the way, you don't have to call your estate planner and make changes to your will every time. You can just work directly with your financial advisor or with Fidelity or Schwab or wherever you have your donor advised fund set up. Seattle Foundation does a lot of this work, of course. And you can just make tweaks with your agent there. And that way you don't have to change your will every single time. So that's a really handy tool for making charitable giving a lot easier.
And then Tiffany, just to jump on that too, it's allows your family to be involved in it as well. So if you set it up during your lifetime, you're, making those suggestions of where you would like the, which charities to benefit. But at the same time, upon death, you can state that your child or your sibling or somebody else steps into that kind of role to keep that donor advised fund going. So it doesn't necessarily have to stop with your family at death, especially when people are considering foundations versus existing public charities, things along those lines. A lot of times the donor advised fund gives people that kind of balance that they need of, I want my kids or other family members to be involved in this kind of legacy planning, but I want to leave it flexible for the different types of charities that are, kind of in the realm of what you want to support. And then they kind of keep doing things based on what you've said you'd like to benefit.
Exactly. Thanks for that. So that is kind of in a nutshell, some of the gift tax issues and some of the kind of planning issues surrounding that. The one other thing that I want to mention before we close today, just because I actually really like this tool. I think that it is very smart and it affects a lot of individuals. And it's one of those things that people don't think about all the time. I mentioned this already. I'm alluding to something that came up earlier, life insurance. A lot of us have it. There are seasons for it. I don't sell the product, so I'm not recommending it or not, but there are certainly seasons. You have young children, you have somebody who's a dependent, you have a mortgage, you have estate taxes that you want to utilize this life insurance policy to pay. There are a number of different reasons that insurance can make sense. And when it does, and individuals have it, it is oftentimes a very big ticket item, so to speak. I have administered estates where the individual was not a wealthy individual, but then suddenly at death, there was a significant amount of insurance, putting them in a taxable estate situation. And that is something that with proper planning does not have to be. So because so many folks do have insurance for one reason or another, this comes up a lot. And one way to utilize that insurance as a tool for the benefit of a spouse, children, family, whomever, or, as a mechanism to pay, estate taxes that are going to be due based on your other assets, you can set up what's called an irrevocable life insurance trust. And that's something where it's a trust that essentially will own the real estate or own the life insurance policy. And you can continue to pay the life insurance premiums annually. The beneficiary that you have designated on the policy now, before you set up the trust, can be the beneficiary of the trust. So for example, I have a life insurance policy. My husband is the named beneficiary. If I wanted to utilize this tool, I could set up the trust, name Nick as the beneficiary, and then change title of the policy, essentially transfer the policy into that trust. And what that does is it's an irrevocable transfer during life. So it is a gift. So there can be a gift tax component. But again, with the federal gift tax exemption amount, I don't currently have a problem with that. I hope to someday, but I don't currently. But looking out for, look out for that. But also, what it does is it effectively reduces, say my policy is $1 million, it reduces my estate by $1 million. So when I'm looking at whether or not I'm going to have a taxable estate situation in Washington, because the exemption's $2,193,000, I might have a house and a life insurance policy, and suddenly I'm there. Whereas if I can remove that life insurance, put it into the trust, still have that benefit for my beneficiary, but it's outside of my estate now, it's very handy. I think it's a really smart tool. It works in a lot of circumstances and for a lot of people. And so that's why I kind of want to close with being able to raise that. It's called a irrevocable life insurance trust, an ILIT. We we use acronyms for everything in our practice, but it can be handy if insurance is part of the estate makeup. It can be a handy asset to put, or a handy tool to put an asset in. So with that, Liberty, unless you have any closing remarks, I'll ask Kara to come back on and close us out. And thank you so much for joining us and for tuning in rather on our follow-up to Talking Taxes.
Thank you both. That was incredible. So much information. I have to say we use a lot of acronyms in library world as well. So I feel very at one with you right now. I just want to thank Tiffany and Liberty again so much for being so generous with your time and for caring so much about the responses that we got after our last webinar to want to follow up with everybody. We're just so grateful. And thanks to all the viewers who asked so many great questions to give us fodder for this very session. Again, I'm Kara McDonald with the Seattle Public Library Foundation, and we are proud to offer this free webinar series in partnership with the King County Library System Foundation. Please be in touch if there is ever anything we could do to help you as you plan your legacy. Our contact info will be on screen shortly. Thank you all so much again, and take care. Thank you.